Welcome to Chapter 13, which is the final chapter in managerial accounting. And here we are going to spend our time, now that we've developed all of these different decision-making techniques, now we're going to go through and look at how to analyze and interpret financial statements. Typically, another name for this is ratio analysis. And what we're going to do is we're going to look at four different aspects, four different types of ratios. We're going to look at liquidity and efficiency ratios, which measure our ability to pay our short-term debts. We're going to look at the second major type, and this is found, by the way, on slide 6. The second major category of ratios are the solvency ratios, which measure our ability to meet our future obligations. The third major category of ratios are the profitability ratios, which measure our ability to provide financial rewards sufficient to attract investors. And the fourth, market prospects, measure our ability to generate positive market expectations. We're going to just cover these. There's two things that I want to go over first. We have several other types of analyses that we do. We have three types of analysis tools that we use. We have what are called horizontal analysis, vertical analysis, and then finally the ratio analysis. The horizontal analysis shows that what we're doing is we're taking each line item on the company's financial statements and analyzing its dollar change and its percentage change. If we go to slide 13, we then look at trend analysis, which would say, okay, we're going to look at a base period amount, and we're going to take our current period amount and compare them to figure out if we're percentage above or percentage below. One very important point to stress here using ratio analysis is that one point in time is insufficient to draw any meaningful conclusions. You need to do a historical analysis. For example, if I have two companies that have the same ratio, and let's say it's 2.0, and they're both at this point in time, I would say, wow, those two companies are equal. However, if I looked historically and company A's ratio went from 4 to 2, company B's ratio went from 1 to 2, we get a totally different picture. So again, keep in mind that use of ratios, we need more than just one point in time. Okay, with that, let's then look at slide 18, our common size statements. And again, this is our trend analysis here, where we would get our common size percent, calculate it out, and then we would know whether we were percentage above or below on either the balance sheet or the income statement. So now let's move to the ratios themselves. And again, we're going to cover these pretty quickly just as a way of introduction so that you get to know them. And again, we have the four major segments: liquidity, solvency, profitability, and market prospects. The first of these is the liquidity and efficiency. We have 7 of these, and we'll just scroll through here. I'm just going to highlight these pretty quickly for you. Slide 30, we have the current, we have our working capital, and then we move to the next slide. And then you'll see that our current ratio is merely current assets divided by current liabilities. We typically like to see a ratio of about 2 to 1. If we move to the next slide, we get the acid test ratio, and the only difference between the two is that in the acid test ratio, we exclude inventories. Here we like to see a benchmark of 1-to-1, and the reason we exclude inventories is this helps us analyze whether a company is loaded in old or obsolete inventory. Slide 33 gives us accounts receivable turnover, which essentially says how many times our receivables are turning over, which if we look at taken into combination with the next slide, inventory turnover, this tells us how many times our inventory is turning over. With both of these, the greater the number, that means the fewer days we have in accounts receivable and the fewer days we have in inventory. If we move to slide 35, the days in receivables, this is really important for your bankers because this lets them know how good are your receivables. The shorter the time period, the more likely you are to collect. If we move to the next slide, slide 36, the days sales and inventory, here we like to see, again, a relatively shorter number, lower number, because this gives us the relative age or obsolescence of our inventory. And then finally, the final measure of liquidity and efficiency is the total asset turnover, which is our net sales divided by our average total assets. It tells us how many dollars of sales we generate for each dollar invested in assets. So real quickly, those are the first major block, the liquidity and efficiency. If we move to the solvency, here we have four major ratios. The first in slide 40 is the debt ratio, and that's merely comparing liabilities to assets. It lets us know what percentage of our total assets have been financed by creditors. Slide 41 shows the opposite. It shows what percentage of our assets are financed by our owners. Now, if you're a creditor, you want to see a very high equity ratio. You want to know that the owners are heavily invested in their company. If you're an owner, you want a very high debt ratio because you want to be able to have your money free to invest elsewhere. So then we do the debt to equity, which is, again, it's a complement to the first two. It's just another way of looking at the debt equity situation. We just, it is a ratio of creditor money, liabilities versus equity. And finally, we have the times interest earned, which is another very important ratio for your bankers because this lets them know how many times your net income covers your interest expense. The higher the number, obviously the more comfortable the bank feels because that lets them know that your net income could drop but you can still repay your loan. So that's the second major group. Now we move to the third major group in slide 44, the profitability ratios, and we have 6 of those. The first of those is the profit margin, and we talked about the profit margin incidentally when we looked at the ROI in one of the earlier chapters. The profit margin is merely the net income divided by net sales, gives us an idea of for every dollar of sales how much do we generate in net income. The next is the gross margin, which is our net sales minus cost of sales divided by our sales, and this lets us know before we cover all our selling and general admin expenses, what is our gross margin. Slide 48 looks at what is commonly called the ROA, return on assets, and it's a net income divided by the average total assets. That is typically considered the most beneficial of all the assets. It is also called the ROI. Notice it's the same formula that we used in the ROI, net income divided by average total assets. If we move to the next, we have ROE, which is return on equity. Here we're trying to find out what is our net income divided by our average stockholders' equity to give us a percentage return on investor money. Then we have the book value per common share, which is total shareholders' equity divided by the number of shares of common stock outstanding, and this is used in order to develop an assessment of the value of the price of the company's common stock. And then finally, we have the EPS, the earnings per share, which is probably the most looked at measure of profitability on the stock market, and that is net income minus your preferred dividends divided by the average common shares outstanding. So that's our third major group. And then finally, we have the market prospects on slide 52, of which we have two of those. We have the PE ratio, and then we have the dividend yield. The PE ratio tells us what the price of the stock is divided by the earnings per share, and we get a valuation index, which is a very closely watched indicator on establishing the price of the stock. And then the final is the dividend yield ratio, which looks at the dividends per share divided by the market price per share. That concludes the fourth of the major ratio groupings. And with this now, you have an ability to calculate all of these ratios for your company or to compare yourself to others as a way of being able to determine whether how your company stands compared to itself historically and compared to others in the same industry.